In this week, as we review accounting, which serves as the background for the chapters that we'll be treating a few weeks from now, we need to address one very important topic, which is the basic financial statements. There are three basic types of financial statements: the income statement, balance sheet, and statement of cash flows. As already discussed, finance is a blend of accounting, economics, and other disciplines. Investors are interested not only in short-term but also long-term growth of the company. Income statement measures the profitability of the firm. Price earnings ratio indicates relative valuation of earnings. Balance sheet shows assets and financing of assets with debt and equity. Statement of cash flows indicate change in the firm's cash position. And depreciation provides tax deduction benefits that increase cash flow. Income statement, device to measure firm profitability. It covers a time period. It may be from January 1 to December 31, or it may be from 1st of June to the 31st of May of the following year. It always covers a given period. And the heading of the income statement is particularly important when you compare that heading with that of the balance sheet. The balance sheet actually represents the financial position of the company, which is the net worth of a company as of a given date. December 31, for example, June 30, for example. The income statement is presented in a step or progressive fashion to examine profit or loss after each type of expense item deducted. We're going to take a look at Table 2.1, Income Statement for Kramer Corporation. Here it is. Let's try to understand the meanings of the financial statements. Over here, the income statement begins with the aggregate amount of sales revenue that are generated within a specific period of time. So if a company happens to be a service company, like a law firm, accounting firm, it will have service revenue. And there are cases where we have a company that is selling a product and also providing a service, like a computer company that sells computers and also repairs computers. So it's going to have a combination of sales and service revenues. The various expenses that occur in generating sales are subtracted in stair-step fashion to arrive at the net income for the defined period. As you can see over here, you have all these expenses. You have cost of goods sold, then you have a gross profit. All right, all the way down, you will see expenses being deducted. You have selling and admin expenses and depreciation expense that will give you operating profit, which is also called earnings before interest and taxes. And then you take out interest expense, you have earnings before taxes. And then you take out taxes, okay, which is a percentage of your earnings. And then you have earnings after taxes. And then preferred stock dividends that are declared. And then you have earnings available to common stockholders. And then what you have is common shares outstanding. So you divide the earnings available to common stockholders by the common shares outstanding, which is 100,000 divided by 100,000. Your earnings per share is then $1. So that is just a very simple income statement. The separation of the expense categories, such as cost of goods sold, selling and admin expenses, depreciation, interest, and taxes, enables management to assess the relative importance and appropriateness of the expenditures in producing each level of sales. The bottom line value, net income, is the aggregate amount available to owners. Net income is converted from an aggregate value to earnings per share value by dividing net income by the number of shares outstanding, which is exactly what you have right here. You have your net income, of course, you divide it by number of shares outstanding, then you have your EPS, earnings per share. The EPS is a measurement of the return available to providers of equity capital to the firm. The return to the providers of debt capital interest appears earlier in the income statement as a tax-deductible expense. Earnings per share may be converted to a measure of current value through application of price-earnings ratio. The price-earnings ratio is best used as a relative measure of value because the numerator, price, is based on the future, and the denominator, earnings, is a current measure. The price-earnings ratio is best used as a relative measure of value because the numerator, price, is based on the future, and the denominator, earnings, is a current measure. Whereas the income statement provides a summary of financial transactions for a period of time, the balance sheet portrays the cumulative results of transactions at a point in time. The balance sheet may present the position of the firm as a result of transactions for 6 months, 25 years, or other periods. So you can see when you're taking a look at the balance sheet, it gives you the financial position of the company as of a given date. So you can determine the net worth of the company. The balance sheet is divided into two categories. The assets employed in the operations of the firm compose one category, while the other, liabilities and net worth, is comprised of the sources of financing for the employed assets. Within the asset category, the assets are listed in the order of liquidity. That means in the order of conversion to cash. That is where cash is the first item. When you take a look at your balance sheet, including deposits, demand deposits, you have marketable securities as the second item. That is a current asset. Marketable securities are investments of temporarily excess cash in highly liquid assets. Then you have accounts receivable, which means the company is selling to customers on credit, some customers on credit, based on their credit worthiness. And then you have inventory. And then you have prepaid expenses, which represent future expense items that have already been paid, which could be insurance that you pay for a whole year. So if you pay the insurance for a year and you're computing your financial statements or balance sheet as of a given period, you have to determine what part of the insurance is unused. Investments in securities and other assets for longer than one operating cycle. And then you have plant and equipment adjusted for accumulated depreciation. Depreciation, of course, is the writing off of the used portion of a given asset. And after a few years, you have accumulated some depreciation, which means at a certain point in time, the asset is now worth less than it was when you purchased it. For example, let's say you purchased a computer for $1,000 and you're writing off depreciation, $200 every year. So at the end of 5 years, the accumulated depreciation will be 200 times 5, which is 1,000. So technically, at the end of 5 years, the book value will be zero because the cost is $1,000. The accumulation is also 1,000. So if you take the original cost of the asset and you take away the depreciation, the accumulated depreciation, which is depreciation over the life of the use of the computer, then the balance will be 0. So the various sources of financing of a firm are listed in order of maturity. Those sources that mature earliest, current liabilities are listed first. The more permanent debt and equity sources follow. And then you have accounts payable, notes payable. You have accrued expenses, which are obligations to pay that are incurred, but payment has not been made. You have long-term debt. All of the majority of the principal will be paid beyond current period. Then you have preferred stock. And then you have common stock accounts. And common stock accounts can be broken down into common stock par value, capital paid in excess of par, and retained earnings. Once you take a look at your balance sheet, you will see how all these things, all these elements are placed on the balance sheet. But for now, we're just focusing on the income statement, and I don't want to dwell too much or discuss too much about balance sheet beyond just talking about the income statement. And of course, balance sheet does have its limitations, so does the income statement. So for now, let's continue discussing the income statement. Okay, looking at the income statement, the computation of gross profit is sales figure minus the cost of goods sold right here. So if we were to go back right here, you will see that we have sales minus cost of goods sold. Sales is 2 million minus cost of goods sold, which is 1,500. Then the gross profit is 5. Okay, and then we have gross profit minus expenses minus depreciation, which is EBIT, earnings before interest and taxes, or operating income. So let's go to the table right here. Let's get to the income statement right here. I'm sorry. So what you have here is your gross profit minus selling and admin expenses minus depreciation, that is operating profit or earnings before interest and taxes. All right, so the earnings before interest and taxes minus interest expense, which is earnings before taxes. Investors are interested in the cost of financing. That is why you take out interest expense from earnings before interest and taxes. So once you take the interest out, which is the I here, so you have EBT minus taxes, which is earnings after taxes. Okay, which is earnings before taxes minus taxes is earnings after taxes, or just plainly net income. Okay, return to capital. There are 3 primary sources of capital. You have bondholders that receive interest on a periodic basis, fixed amount. And then you have preferred stockholders. They receive dividends based on the performance of the company and based on the dividend distribution policy of the company. Management may decide not to declare dividends for the purpose of reinvestment of cash or reinvestment of income that is made. Common stockholders fall in the same category. The only difference is common stockholders are paid after preferred stockholders receive their payments or receive the dividends. And then you have the computation of earnings per share, which we know already. That is net income divided by a number of shares outstanding. So if we go back here to the income statement, you will see that your common shares outstanding is 100,000. Your earnings your earnings available to common stockholders, which is your net income here. If you divide this by this, 100,000 divided by 100,000, your earnings per share is $1. Okay, so we're moving forward right here. So here we have earnings per share may be paid out in dividends or retained by company for subsequent reinvestment. Exactly what I just said. Okay, so there are times when management decides that it wouldn't pay dividends to shareholders, and then they would just advise the shareholders that there is a need for reinvestment of their money. And in some cases, there may be a conflict, which we call agency problem, because the shareholders may not be interested in a given investment. The managers of the company, the CEOs, CFOs may have a different agenda. So that creates a conflict to some extent, which we call agency problem. All right, moving forward, statement of retained earnings. Over here, okay, we have statement of retained earnings, which indicates disposition of earnings with adjustments to previously reported income. And then you have restrictions on cash dividends right here. So it's pretty simple. So over here, you have 250, and then now you have earnings available to stockholders, which is the 100,000 from the this page right here, which is this right here. So let's go back, and then you take out the cash dividends declared, okay, which is that means the company decides to pay cash dividends to common stockholders and preferred stockholders. Okay, so the total earnings that will be in statement of retained earnings will be 300,000 in this case. All right, so the last slide here, we have price earnings applied to earnings per share. So multiplier applied to earnings per share to determine current value of common stock right here. And what are the factors that influence price earnings ratio? Earnings and sales growth of the firm that will affect the price earnings ratio. The risk, which is volatility in performance, that is the extent to which there may be fluctuations in performance of the company. Some years may be good years when the company makes money. Some years may not be as good when the company doesn't make money. So that volatility in performance is what is called risk. Debt equity structure, that is the extent to which the company uses debt and equity to finance its assets. Dividend payment policy, that is the kind of management policy, whatever management decides to do regarding payment of dividends. In some cases, management may decide to just hold on to dividends for the purpose of reinvestment, or they may say since they haven't paid for 2 3 years in a row, they may decide to pay the shareholders, common stockholders and preferred stockholders, a given percentage of earnings just to make them feel happy to some extent. And then quality of management will determine price earnings ratio. The management is astute, very professional, always protecting the image of the company, no frivolous lawsuits of some kind by some people outside of the company or inside the company that may impact price earnings ratio. Okay, this is the end of the lecture for this week. Thank you so much for listening. So we'll talk again next week. Good day. Bye bye.